Today's episode is brought to you by Bit.com. You'll be hearing more about them later on in today's interview, which begins right now. Really excited for my next guest, Sean Fieler, Chief Investment Officer of Equinox Partners. Sean, welcome to Forward Guidance.
Thank you for having me.
It's my pleasure, Sean. You work in areas that the type of companies you invest in, I think really are at the crux of what's going on just in the macro economy. And they're also areas that the layperson doesn't really have access to by sort of, the mainstream financial news. So just let the audience know, what are the two areas, what are the two types of companies that you invest in typically, and also where they're located?
So we're contrarian investors, value investors, and so that's usually pushed us off the beaten path. For much of the last 2 decades, we've been in gold mining and oil and gas companies. And a lot of those assets, so in the E&P space, a lot of those assets are in Canada, but in gold mining, a lot of those assets are in emerging market and frontier countries.
Okay, and I want to draw a distinction here because the reason there are money managers is to generate alpha relative to some benchmark. And if there's a fund that's investing in technology, let's say, maybe their benchmark is the Nasdaq 100, and people, they may have done well because the fund manager generated a few points of alpha, but they also did well by just allocating passively to the Nasdaq 100. The types of sectors that you deal with, Sean, correct me if I'm wrong, could not be more different. They are by definition a stock picker's market, because if you just look at the indices, whether it's GDX or GDXJ, the junior gold miners, or the exploration ETFs for oil, they've had a very, very bad past decade. Is that correct?
So the gold mining companies in particular, it's been a rough decade. The same thing's true with the E&P companies. There's been a lot of volatility within that last decade, but on average, obviously much worse than common stocks, the S&P or the Nasdaq for sure. And there is a lot of dispersion within that space. So certainly within like the junior mining sector, you're talking about a real range in terms of the quality of the assets, in terms of the quality of the governance. And so, there's a lot of value to be added by stock picking.
Mm-hmm. And Sean, how much do you follow macro? I know a lot of stock pickers, they like to focus on balance sheets, the companies, the profitability. They don't really focus on the macro, the Fed. What about you?
So if you're doing EM and frontier market investing, you're not ignoring macro, kind of by definition. And so one of the formative experiences in my career was the Asia crisis in the late 90s and then the Russia crisis in 98. So in the case of Indonesia, if you were down at the lows 99% in dollar terms, a lot of that was macro, not company specific driven. And so there was really never any rational participants in these markets that thought you could ignore the macro. And it's just the reality of investing in most of the world, certainly outside of developed markets. I think now we're finding that it's going to be maybe as relevant in developed markets, and but that's not a surprise, certainly to us.
Yes. So in that scenario, the Asian financial crisis, the Asian currencies weakened tremendously against the dollar. So in dollar terms, investors lost a tremendous amount of capital. How do you see those issues playing out today with currencies?
For most of the assets that we have in emerging markets, we're talking about gold and silver revenues. In some cases, we have E&P companies there, but then again, we're talking about dollar revenues. And so weaker currencies are largely offset by inflation in a lot of these geographies. And so it's something you have to watch, and you watch from a timing perspective. It's been an opportunity recently because a lot of the EM currencies have been weak to create better margins in the companies we're invested in there. But I'd say it's really country specific in terms of kind of the analysis we're doing.
Okay, that's really interesting that dollars, the petrodollar system, oil is sold in dollars, but the input cost, if it's in an emerging market, is in that emerging market currency. So if that emerging market currency weakens, the input costs go down in dollar terms, but the output, what you're paid in dollars, stays the same. So weakening currencies can actually be good for investing. Is that what I hear, or no?
Yeah, so like in the case of Turkey would be a good example where the lira has been very weak, and there we're not invested in E&P, but in mining companies, some assets in Turkey. So a lot of what you're gaining, though, in terms of the currency depreciation is being offset by very high rates of inflation. So you can get a temporary benefit in terms of the operating cost of the mine, usually much less of a benefit in terms of the capital cost of the mine. But then you have a lot of volatility as you're catching up with that depreciation, right? In terms of the inflation that's catching up with that depreciation. So Brazil would be a good example of a currency that's rallied recently. So if you were investing on the basis of forever weaker real, your margins could get squeezed pretty quickly when it goes against you. So it's just something that's it's part of investing in these markets.
And how, so the Federal Reserve right now is tightening monetary policy. It's projected to raise the Fed funds interest rate to as high as over 3%. Trillions of its balance sheet is expected to roll off its balance sheet. How have what have you learned from prior Federal Reserve hiking cycles, or should I say tightening cycles? Maybe we can take 2018, the famous Powell pivot, as well as perhaps 2014, which didn't involve, I don't think, any hiking at all, but merely the taper, I know, caused a lot of distress in emerging markets and commodities, and in particular currencies.
Yeah, so the old adage was that when we get a cold here in the United States, EM gets pneumonia. You will have certain countries get overextended in terms of their balance sheets, and then to the extent that they can't really raise the dollars they need to pay their debt, you'll have a lot of stress and potential defaults. So right now, Ghana's got a problem, Egypt's got a problem. There's a number of emerging market countries that are kind of on that, north of 70, 80% debt to GDP line, where they don't have a lot of wiggle room, and so then you have a couple problems. But for us, I think the biggest problem is going to be: do you have a change in terms of tax treatment of your local assets in those countries when the government goes through that kind of financial stress? So in Ghana, you're seeing that right now. So they just put an enormous new tax on their largest mobile money telecom company in an effort to try to offset the budgetary pressures that they're facing. Some mines there will have fiscal stability agreements, which kind of renegotiation of would be equivalent to a sovereign default, and others don't, where you're going to be subject to higher taxation as that country goes through a rough point in their domestic fiscal cycle.
And the debts that these emerging market countries have, how much of it typically is in the home country where they can just print money and pay it off versus it's in the dollar and they have to print money that will weaken against the dollar, and it's sort of it's a vicious cycle?
So it's a mix, and it's country by country. As you say, right, the higher the fraction of domestic debt, the more soluble their problem is in terms of running the printing press. The rates on that debt, though, then tend to be higher. So you tend to get a combination of negative real rates as these countries get more stressed in financial repression to trap the capital. So you have a number of these countries will no longer have freely convertible capital accounts. So Ghana and Nigeria are good examples of that. So there's a lot of games they tend to play the more stressed they get. But this is part of the reason why assets in these countries are, I think, mispriced. They're not kind of on the list of most people's list of things most people want to own. I would say the Francophone West Africa, where we have a number of gold investments, has been a really a pleasant place to invest from a currency and inflation perspective, because they've tied their currency, the CFA, to the euro, and that peg has held for a number of years. And so you've had free convertibility and moderate rates of inflation in Francophone West Africa. That's kind of atypical of what you've seen in most frontier markets.
How big of a threat do you think monetary tightening is to emerging markets? Not necessarily the specific type of companies that you invest in, of mining companies in West Africa, but just like emerging markets such as EEM, that ETF, let's say, really broad based.
Yeah, so the cycle can be rough, I think. So starting back to your original premise, which is that EM has really underperformed developed markets for a decade. So you're talking about a starting point that's very dissimilar to, say, what you had at the start of the Asia crisis, right, where you had a lot of froth and exuberant capital flows into emerging markets. So you're starting at a low point. That's not to say that it can't get worse. I would say that the experience is going to be varied, right? You're going to have some countries that are going to have more of a problem, other countries that have been more responsible. And then the composition of those countries' GDP and their export base is also going to have a real effect in terms of how they experience this crisis. So something like Peru, you would say, low debt to GDP, responsible monetary policy, well-capitalized banking system, and then commodity-based, commodity-heavy exports, especially copper, that have done very well recently. All that, you think would bode very well for Peruvian macro. Then they have an election and elect an avowed communist, and you've got another problem. So the vagaries of investing in these markets, that's just the nature of frontier and emerging market investing.
I know in sort of a textbook 101 emerging market crisis is, let's say the Federal Reserve hikes interest rates, it sucks capital from all around the globe to the dollar-based higher rates. And that therefore central banks of emerging market countries, they see a capital outflow, they have a choice to either devalue the currency or to deflate. So either raise rates and cause a recession, perhaps you slow down the economy to keep capital back, or just let the currency depreciate. And I guess door number 3 is capital controls. And as you alluded, perhaps Ghana, you said, had them as well. That would be, of course, more government, not central banks. But what sort of solutions are emerging market central banks choosing now? I know, for example, like Brazil, they've hiked interest rates a lot, but are a lot of emerging market following the example of Brazil, or are some central banks not hiking rates in response?
Yeah, you're seeing rate increases in general, and then you're seeing also a lot of the emerging market economies are much less leveraged than, say, the developed world economies or the U.S. economy. So there's a lot more space to raise rates without breaking things. Real rates in a number of these economies are still negative. So even if you're taking rates up, like let's say in the case of Turkey, you can take rates up quite a bit before you get to anything approaching a real positive real rate if inflation's running at, I don't know, call it 50%, something like that. I think a lot of these currencies long term, it's not clear that there's a real constituency to own them other than people that want to, foreigners that want to invest in businesses in those countries. Do people really want the lira exposure absent a very high, real rate or a trade? The answer is probably not, unless they actually live there. So I think that's a kind of a perennial flashpoint for a lot of these markets, and then a lot of the central banks are managing it in ways that are political. I mean, our central bank is political here, but their central banks are, even in the case of Turkey, would be a poster child for what has historically been a highly politicized central bank.
And how are you weighing the risks at this current juncture? Because a lot of analysts focusing on the American economy are very worried that the Federal Reserve will have to essentially cause a recession, tighten to the point that something breaks in order to break inflation. Is that a problem for emerging markets? Could it actually be good? Because, for the first time in a very long time, U.S. inflation is actually higher than the rest of the world's. How are you sort of thinking about this?
Yeah, I think they have a problem. I don't think they're going to be able to get inflation under control without causing a recession. I think if you cause a recession and a big correction in financial asset prices, given the debt to GDP in the United States, it's not clear that then puts you on a sustainable path unless you have, meaningfully, really high nominal GDP growth in the United States, because there's not an appetite to, say, cut spending and reduce deficits into recession here in the United States. So I think they're really painted themselves into a corner. And so I think we'll see something similar to what we saw in 2018 when Powell tried to normalize and then had to back off. We're down now 20+% in the NASDAQ year to date at 25% and 18% in the S&P. So it seems like they're very much on this kind of path that Bill Dudley laid out in terms of correcting asset prices to drive a recession in the U.S. economy. But I don't think they'll really have the appetite to get anything close to meaningfully positive real rates, because I think the math just doesn't work. And then you overlay that on that kind of the reduced appetite for foreigners to buy dollars, right? In terms of with the dollar index now 104, something like that, on a trade weighted basis, the arbitrage doesn't work any longer for the Japanese, and it's no longer clear that, given the expropriation of Russia's reserves, that the Chinese and other countries that are going to have some potential conflict with the United States are going to want to own dollars in the same size that they would have historically. And so I think as you're starting to think through who's going to plug that $1 trillion gap. If the Fed's not going to do it, you can get to a conclusion that maybe rates here in the United States have to be higher and the dollar has to be weaker. And then that on a net basis would be good for EM.
Right. I just want to make clear, you said people don't want to buy dollars and yet the dollar is high. Let me explain that to the audience is that people don't want to buy treasury bonds. Japanese investors, when they buy a treasury bond, they usually have to hedge that foreign exchange risk. And because the DXY has exploded higher, because the yen has collapsed, those hedging costs are now higher. So that will decrease foreign investors' appetite for treasuries, not increase. And actually, we've seen something like $60 billion of outflows of Japanese investors dumping U.S. treasury bonds. Sean, where do you stand on this whole Bretton Woods, the new Bretton Woods? The dollar is going to be replaced as a global reserve currency. Obviously, if it happens, it's not going to happen overnight. Everyone knows that. But how long do you think this whole little charade, the dollar charade, lasts?
Well, Michael Borda wrote a paper on the gold pool going back about 4 or 5 years ago, and the London gold pool was operated until March 15th of 1968, and gold didn't really revalue until August of 71. So you had a little over a 3-year period where the policy had changed, but then you didn't really have the revaluation that you would have expected from the changing underlying policy and fundamentals right away. It was, I think, a long 3 years. So I think we're kind of in that moment right now where the world's changed, the policies have changed. We can see the shift in the underlying fundamentals where you're going to have structurally higher inflation. You're going to move towards trading blocks, friendshoring, deglobalization. So you no longer have that massive disinflationary force that we've had for the last decade plus. And you overlay that on very, very high levels of indebtedness and high levels in terms of equity valuations. And I think you have a real recipe for a lot of financial stress. And people, I think, at this juncture should be really changing how they're thinking about their investment portfolio and investing differently than they would have over the last decade. But my sense is it's still early and that hasn't really sunk in. And we're seeing that in terms of the valuations of whether it's gold miners, E&P companies. You're not really seeing an appetite for those assets that you would expect given the changing underlying fundamentals.
Yes. So, Sean, it sounds like you're open to the idea of secular inflation, that this high inflation we have could be here to stay. If that is true, Sean, is that compatible with the previous scenario you laid out where the Federal Reserve backs off because asset prices have collapsed? I mean, if inflation is still at 8% and the S&P 500 has sold off 35%, where do you think the Fed goes there? Yeah,
so I suspect they continue to raise rates. Do they get to positive real rates? I suspect not. And look, monetary policy is political. So you had Lael Brainerd was the champion of the change in the Fed's monetary framework going back into the summer of 2020. Where we moved the 2% cap on their inflation target to a 2% average over time, and then the idea that as we experience higher inflation rates on the back of that, we still go ahead and confirm her for vice chair, is telling you kind of where the politics are, which is that you have kind of bipartisan support for easy money. And you've had that really since, I think, the confirmation of Janet Yellen in 2013 as Fed chair, where you had Senator Corker and others basically round up almost half of the Republicans to go along with her nomination. And for the last 9 years, there hasn't really been a party that's championed sound money. And so the politicking in the Fed has allowed basically the easy money advocates to gain ascendancy and really control of the institution. And I think you're going to see that in the monetary policy. Kind of regardless of where the rhetoric is, that's really who you have in charge of the Fed. And so we're going to see, I think, looser for longer and never really getting close to that line in terms of positive real rates.
Sean, 2 questions. Now, what have you made of the price action of gold, let's say over the past 2.5 years, where briefly sold off during March 2020, exploded higher into the summer of 2020, and since then it's sort of stagnated down, but it has had some renewed strength this year. Do you think that price action confirms, supports, does not support, or is neutral on the idea that gold is an inflation hedge?
Well, we no longer get the question as to whether or not Bitcoin is just a better version of gold. So those have obviously disentangled. It seems like gold is not correlated with risk assets, so it's flattish this year. So you're seeing a real good store of value there. In terms of the flight to gold that you would have hoped, that I would have hoped that we would have seen in this kind of environment, I go back to that kind of into the London gold pool, metaphor. So we're through March 15th, 68, but we're not to August 71 yet. And so the fundamentals have changed, but really the market hasn't taken advantage of that yet.
Okay. And so what's your outlook on gold going forward?
Oh, I think it'll go higher. I think at some point the dollar will struggle with negative real rates. I think gold will look better in relationship to the developed market fiat currencies. I think it'll look better as a store of value. I think it'll look better given the level of indebtedness of the developed world and the monetary policy that has to be pursued in the developed world because of that level of indebtedness. And I think it'll get mainstreamed. So I would guess higher prices.
And what would you say are the main catalysts you think for the sort of bullish future of gold that you envision?
Continuing rates of inflation that are, north of 2%, a lack of ability or appetite on the part of central banks to wring that inflation out of the system. Couple that with high levels of indebtedness, some questions about the sustainability of those high and rising levels of indebtedness, a lack of appetite on the part of, certainly here in the United States, both parties to control the deficits. That's all a recipe that's monetary and fiscal dysfunction overlaid on one another in a way that we haven't really begun to solve.
And if you look at sort of the periods of explosive price action in gold, whether it's, the entire decade of the 1970s or that month from April to August of 2020, and of course, 2000 to 2007, 2009 to 2011 or 12. What is it about those periods that make it such a favorable and hospitable environment for gold to just explode higher?
I think the gold does well when the status quo is threatened in some way, right? So if you can make 20% a year owning the S&P or the NASDAQ, if the Fed can, pick the interest rate that it wants the 10-year to trade at and then set that price, and if that whole financial architecture is really going to be unthreatened and unquestioned, then why own gold, right? So, and to the extent that you start to call some of that status quo into question, at the end of the day, you don't need people to really sell their stocks and bonds to buy gold. You just need 1 or 2% of the stocks and bonds to be sold to go into the gold market. So you're talking about an asset class that in its totality is $13-14 trillion, but it's modest in relationship to the other financial assets, and then it's unique in that it's the asset that is no one else's liability. I think the best reveal in terms of what's going on in the gold market is the persistent central bank purchases of gold. So going into 2008, central banks had continued to divest from gold. Over the last 14 years, they've been persistent buyers of gold, and they remain the single largest buyer of gold in the market today. So the idea that the makers of fiat currency are the biggest buyers of gold should tell you something about the internal dynamics of that market and the attractiveness of that asset.
Yes, the peg to gold, the gold standard is over. However, the fiat, as you say, the fiat, they want to have a little gold in their in their coffers. Sean, I want to ask you how pivotal. So the Russian ruble was it had an incredible devaluation as the Western financial world sanctioned it, tried to cut it off, and the ruble weakened enormously. It has since revalued to levels that were stronger than before Russia's invasion of Ukraine. Right. I know that the Russian central bank has done a lot of things. They're very active. One of those measures they embarked upon was to peg gold to a ruble and sort of buy a certain level of gold at a certain price, implying that while they were doing it, there was kind of like a floor for the price of gold. How, gold historically has been used as a means to stabilize fiat currency. How pivotal was that action, do you think, in sort of restoring the value of the ruble?
Well, let me say first, we're not invested in Russia. I think there's really important moral reasons not to invest in Russia so long as Russia's conducting its invasion of Ukraine. Yeah, in terms of forcing people to buy rubles versus the Russian central bank's decision to stipulate a purchase price for gold in rubles. I can't tell you which is more influential in terms of the ruble's appreciation for the year to date. I think the bigger issue is the weaponization of the dollar. And so if you go back 4 or 5 years, so when we were threatening Turkey because of the imprisonment of Pastor Brunson with torching their economy and depriving them of swap lines and targeting the lira for depreciation. So that was not just a weaponization of the dollar vis-a-vis a member of NATO, but also doing that with public statements from Secretary Mnuchin, then the Secretary of the Treasury, as a way to attack Erdogan. I thought the policy wasn't in the long-term interest of the dollar as the world's reserve currency. It was a little too aggressive. And so I think we're seeing countries deciding that they don't necessarily want to be in the situation Turkey found itself in 2018. And certainly now the freezing and expropriation of Russia's reserves takes that to another level. I think long-term, I think that's going to be a negative for the dollar's reserve currency status.
So we talked about the fundamentals of gold, the metal, the assets. Later on in our conversation, I'm going to ask you about your investments in junior gold miners, what you look for, the green flags you look for, the red flags you look for, what you see in the space. But first, I want to ask you about energy, oil, and gas. Today's episode is brought to you by Bit.com, a leading cryptocurrency trading platform. From spot to futures to options trading and more, Bit.com has it all. So whether you're a seasoned investor or you're new to the game, you need to be on Bit.com. Bit.com has launched a zero taker fee option campaign until May 10th. To enroll, email VIP@bit.com. That's bit spelled B-I-T. So email VIP@bit.com and tell them I sent you. I know you made some investments in E&P exploration and production companies in early 2020, when there was a huge sell-off in the market, but particularly in those beleaguered energy stocks. What was it that sort of made you want to take on what at the time seemed like a very, very risky investment?
Well, I think, the oil production that the world needed wasn't sustainable with an oil price of less than $70. And so we'd seen in the years prior to 2020 that oil could go to $20 or $26 at the lows in the previous cycle, and in 2020 we saw futures go negative, obviously. So enormous amount of volatility, and then on top of that, natural gas even more volatile. For a number of years, we had assets in the Western Sedimentary Basin in Canada that were basically getting very close to zero, or only $1 per MCF on their natural gas.
Sorry, what do you say when you say $1 per MCF? What do you mean? Sorry.
So $1 per 1,000 cubic feet of gas. It'd be like it's like the common metric by which gas is sold here in the United States, whereas in Europe they sell it on an energy equivalent basis. But it's basically it'd be like if I'm telling you oil's at $100 a barrel, 1,000 cubic feet would be the equivalent metric in gas that people would use for the benchmark price.
Okay, right. And so we say a dollar, that's the price that it cost them to make, or that's the price they got to sell it?
So in the Western Sedimentary Basin, you had at some of the terminals, you had problems getting the gas out because of the pipeline capacity. And so in some cases, they could sell the gas for basically nothing. In some cases, they'd get a dollar or two per MCF. Right now, you have natural gas at Henry Hub in the United States trading between $7 and $8. So there's been a big revaluation in terms of spot pricing, in part because you had really much better capital discipline on the part of the E&P companies here in the United States in terms of not overinvesting and not investing in oil and gas that exceeded their ability to produce it or the market to absorb it. And in oil, that's a global market. In gas, that can be a very regional market. And so your ability to achieve a good price for your natural gas depends upon the responsible investment of companies in a particular geography in a way that's not true in most cases for oil. in 2020, you had unsustainably low prices for oil and gas. You had companies were being valued on the idea that they weren't ever going to achieve a sustainable price for their oil and gas reserves. And so even companies with premium assets, top quartile assets in terms of their cost or their quality or the life of the assets, were being valued as if though they had basically no terminal value or were very marginal companies. And that's just not true. And so we were able to buy some of those companies at these very distressed prices back in 2020. And over the last 2 years, we've seen a nice revaluation of those companies.
Definitely a very nice revaluation. But Sean, it was quite a journey. If you bought Apple or Facebook or Microsoft in the depths of March 23rd, it was pretty much up every day. It was straight green. But with energy, I mean, just looking at like an ETF, it revalued up to September. But then you had another pretty brutal sell-off in the late summer, early fall of 2020. What was that like? And then how did that sort of set the stage for the epic bull run that we've been on since then?
Well, everything was a lot easier than the lows in April of 2020. So, with the kind of the zeitgeist of the ESG movement and the idea that we were going to decarbonize and it was going to be painless, and that these were assets that were going to be worthless not in 30 years but in 5 or 10 years, and that they were just never really going to recover. By the fall or the late summer of 2020, you'd really gotten to a point where that clearly wasn't the case, right? Oil prices weren't going to be sustainably negative. You were going to have to move back to some reasonable long-term price for oil and gas. And we also started to see some M&A. So in one of the 2 companies that we were invested in Western Canada, bought a 20% position in another company there that was particularly undervalued, kind of putting a floor under the price. So there started to be some M&A activity, corporate activity in the space that started to indicate that you were really well beyond the bottom by the fall of 2020.
And then the huge bull run that started from November and pretty much has been, ongoing. To what have you attributed that? And have you been adding positions? Have you been scared or nervous by how well it's been working? If that you've ever happened.
Yeah, so the valuations are really pretty overwhelming. So even today, early May 2022, our companies have free cash flow yields north of 20% at $100 oil.
And sorry, what is the free cash flow yield, just for our audience?
So free cash flow yield is the actual cash money that you can take out of the business while you reinvest back into the business to sustain production. So you're neither growing nor shrinking the underlying business. You're sustaining it, and at the same time, this is the amount of cash that you can take out. So it's kind of like an earnings proxy, but the way tax works in the E&P business, you tend to use a different metric than actual earnings. So on an EV, enterprise value to debt adjusted cash flow, you're talking about these companies trading on half of their historic valuation. So they trade on about 3 times EV DACF versus historical multiples of 5.5 to 6.5, something like that. So you're still at these very compressed multiples because the market simply doesn't believe that spot pricing in oil, or even significantly lower, but $4 to $5 gas pricing is lower than spot pricing in gas is sustainable. And so you're able to buy these companies at incredibly attractive multiples. And so we really haven't had any kind of concern about the run in these companies so far because the valuations have all been really supportive of the prices that we own these companies at today. I think they could easily double from here still. And the market still remains, I think, unduly pessimistic about the future price of oil and gas. So if you take oil prices out and you go out 4 years, you're still in the low 70s in terms of where WTI is trading. And that just, I think, doesn't reconcile with where the supply-demand fundamentals are in the industry.
So there's sort of at least 4 big tailwinds at the back of the energy investors since October, November of 2020. Number one, economic growth, which was projected to be very low or negative, exploded higher. As such, natural gas and price of oil went higher. Also, you had inflation, which makes sort of short duration cash flows more attractive and technology long duration bonds less attractive. So you had inflows into there. you had the ESG, you had supply being very low because ESG underinvestment, and that's four. And then five, I might also add, yeah, I guess that's four.
So the biggest factors I'd add to that there's just been a real sea change in terms of the way E&P companies are allocating capital. So in the previous cycle, right, they were not just spending the cash flow they had, they were borrowing money to invest in these, what they saw as high return wells on the idea that oil prices were going to be sustainably north of $70. You now have an industry that wants to do deals based on $55 oil, and an industry that has spent years promising their shareholders that they're going to return rather than reinvest capital. And so the amount of money they're putting in the ground to expand production is much more modest than it has been historically. And there has been now years of underinvestment. And so that all is a recipe for significantly higher prices. You overlay on that the, say, more complicated relationship we now have with OPEC and OPEC's both desire and ability to produce significantly more oil as they take market share as we've suppressed non-OPEC production. These two factors should lead to higher oil and gas prices structurally for a long period of time, and you should be getting a higher multiple on those cash flows because they're more predictable than what you would have gotten 10 years ago. But the opposite's the case, right? You're paying a lower multiple for better free cash flow returns than you would have going back 7 or 8 years.
How much is so? You say that oil companies are not investing in production; they're investing in dividends, buying back shares. How much do you think oil production is going to rise over the coming years, and how might that compare to a period like 2013, 2014, like the shale revolution, when companies were spending money hand over fist to increase production?
Global market. So you're talking about, in the case of oil, how many millions of barrels a day are you going to add in the coming years? Demand pre-crisis had been growing at more than a million barrels a day, and supply had been keeping up with that. It's an incredibly inelastic market, so you only need a very small difference between supply and demand to really move the price significant amounts. So I think where the market's getting it most wrong is this idea that demand is going to start to moderate and demand is going to peak, and therefore we shouldn't be investing in incremental supply. I think we could see years of growing oil demand. So we're at 100 million barrels a day roughly today. I think that could get to 105 plus out by the end of the decade. And I don't think we have the investment in place to support that. And then natural gas, I think, is an even clearer case where you're going to have a natural gas market that's globalizing. And by all accounts, that market's going to be growing for decades, not just for the balance of this decade. So I think there's a really good long-term investment opportunity here, and you just don't have the market psychology that you have depleting assets that have no terminal value is just not, I don't think, particularly compatible with the actually underlying reality.
Right. Terminal value is what it's sort of valued at the end, and it had been valued so that, in 10 years, not going to be burning this natural gas because of electrification and green energy. Why do you think that's wrong? Why do you think we will be burning natural gas in 10 years? Well,
even if you look at the IEA estimates for natural gas. So natural gas is, I guess now it's green and now it's a transition fuel. It's going to need to displace a lot of coal over the coming decades. So natural gas production and consumption is going to grow globally by everybody's account for more than 2 decades. In terms of oil, that's where it was more political. And if you look at, say, the OPEC's report versus the IEA's report in terms of consumption out towards the latter half of this decade, it's a big difference of opinion in terms of what consumption is going to be, especially what consumption in emerging markets is going to be. And I just don't see the kind of demand reduction and destruction that the IEA is hoping for. If you take a country like Nigeria, for example, where you have about half the population doesn't have access to grid electricity, they have very substantial hydrocarbon reserves. The idea that they're not going to use the oil and gas that they have to electrify Nigeria because we have a desire to decarbonize doesn't strike me as kind of a likely outcome. I think it's much more likely they exploit their reserves and they increase their oil and gas consumption in the coming years and decades. And I think that's going to be true for much of emerging markets, even as oil and gas consumption moderates here in the developed world.
Okay, I think it's a good transition to ESG, environmental, societal, and governance, activist investing seeking to decarbonize and sort of raise the cost of capital, if you will, on fossil fuel companies. Can you describe the effect that ESG investing has had on the energy markets over the past 10 years? And are you seeing a sea change now, given that the price of fossil fuels has exploded higher and arguably there's not enough supply?
Yeah, so I think kind of the engine number one in the CalPERS and the passive investors' victory over ExxonMobil, I think that was probably the high watermark of the ESG movement. The idea that they could get 3 directors to decarbonize a super major over even a long period of time. Maybe they looked okay at the time. I think with higher energy prices, it obviously looks more costly as a strategy. But I think more importantly, after Russia's invasion of Ukraine, that looks maybe geopolitically kind of dumb. Do we really want to transfer market share to OPEC and Russia? And the answer is no. So you're seeing behind the scenes, you're really seeing a big change there in terms of, I think, the behavior in the ESG movement that hasn't really trickled down to the companies. But I think something like what we saw in 2021 there at ExxonMobil was probably the high watermark of the ESG movement when it came to decarbonization.
And were you telling me prior that one of the companies you invested in actually is buying projects from the majors?
Yeah, so there's so investors didn't want to own E&P companies, and to the extent they wanted to own E&P companies, they wanted to own large liquid E&P companies with assets in the developed world or in North America. And so you had, for economic reasons, for investor relations reasons, and for environmental reasons, you've had some of the international oil companies selling off assets in emerging markets. In some cases, like in the case of Petrobras, that was in part motivated by their own balance sheet stress, where they sold a number of on and offshore assets in Brazil at very attractive prices to some smaller, say, $1 billion to $2 billion companies. In the case of West Africa, you've had ExxonMobil, amongst others, selling in assets at very low, we're talking about 2 times free cash flow kind of multiples, because they don't want to be there. It's not just complicated from the E and ESG, kind of the environmental, it's also socially very complicated. And they've chose to exit some of those assets, I think, very attractive prices.
And how high does the price of oil or natural gas have to go before fossil fuel companies invest back in production? And also, Sean, is it a factor of where on the curve the price is? Because if you see a headline, oh my God, oil is at $170, yes, but ExxonMobil is not going to realize that price if the 5-year future price is still at $100, and that's what they're going to have to sell to hedge. So is it, does the back end of the curve have to go up for the companies to invest?
So yes, so they're not going to. So the companies aren't using anything like spot to dictate their investment practices. We just met with a company earlier this week in London, a large intermediate, and they're using $55 to $60 for their budgeting purposes, to give you a sense, and that's with spot well above $100, and you're still north of that even if you go out 5 years in the futures market. You're north of $70. So yeah, they're not using these prices in the natural gas market. Unlike oil, where in oil the price, the farther you go out, the lower the price. Natural gas dips, so if spot prices are $7 to $8, you'll dip down to $4 going out a couple of years, but then you start to rise. So I again, I still see a lot of conservatism in terms of the budgeting of these companies. And in addition to the conservatism about their future price, the future price they're going to receive for oil and gas, you have a default setting, which is we're going to return capital to shareholders. And you still see the market punishing companies for increasing CapEx and trying to ramp production. So it's not just a preference on the part of the managements, it remains a preference on the part of shareholders. Eventually that'll change. Eventually we'll get a cycle where we're going to have markets incentivize boards and C-suites to invest in growing production, but we're just not there yet.
Before we move on to gold, I just want to make clear, Sean, that your investments in energy, again, they're not the majors. They're not Chevron, Exxon. They're mostly companies that, our viewers probably haven't heard of. I haven't heard of them. And they're pretty small in market cap. Would that be correct?
Yeah, so they're $1 to $10 billion companies. So for us, that's plenty large and liquid. But yes, they're definitely not the super majors.
Right, definitely. They're not tiny. They're not like
yeah, they're not marginal companies, but it's not a and a lot of them have actually some of the assets they picked up from the super majors are world-class assets, and in some cases they're actually in a joint venture structure with BP or one of the world's largest oil companies, and so you have the quality of asset, you have management in many cases came from some of the super majors, and so you have from a quality perspective and a management perspective, you're checking a lot of what you want in terms of expertise and governance, but we're paying a lower multiple for both the reserves and the cash flow and the free cash flow by buying some of the smaller companies.
Right, and you're paying a lower multiple because the market is assigning a higher sort of risk premium, if you will. Sean, I want to merge our conversations together. We talked about the price of gold, then we talked about investing in junior energy companies, non-major energy companies. Now let's blend them together, talk about your investments in junior gold miners. I want to say why, first of all, what is a junior gold miner and why invest in a junior miner as opposed to a senior miner?
So junior gold miners are just smaller gold mining companies. So where you have like the GDX would be the index of the larger gold mining companies. The average market cap there is north of $20 billion, whereas the GDXJ would be smaller gold miners. We were talking about the average market cap there being about $3 billion. So most of what we're doing is it's in the sub $3 billion range. So the sweet spot for us would be like the $1 to $5, $1 to $6 billion market cap.
Okay, and what is the opportunity you see in the juniors that you don't see in the seniors? And there are opportunities, but also talk about the risks too.
So for the juniors, you tend to have a handful of assets, maybe one or two assets in many cases, certainly as you get towards $1 billion. Whereas for the majors or the seniors in the gold mining space, you'll have a more diversified portfolio. So investors that haven't visited the assets, don't really want to make a decision about the value of a particular asset or the politics of a particular geography, they're going to be more comfortable in one of the largest companies because they'll have 5+ operating assets. And so they have diversification in that company structure, whereas we really add a lot of value by making an assessment about a particular asset. So we'll go visit the asset. We know the geology. We know the economics of that asset. We understand the local community issues. We understand the regional politics, and we can buy that asset at a big discount to NAV. Whereas if you buy the aggregate of those assets in a senior, you're paying a premium to NAV.
It seems to me, I alluded to this earlier, that doing your homework in investing, it always pays off, but there's a question of how much it pays off. Like if someone invests in stocks that are in the S&P 500 and they listen to the earnings calls, they read the 10Ks, they get the phone number of the analyst, they talk to them, they might outperform the S&P 500, but a lot of it is luck. But it seems that someone who's actually visiting the gold mines knows how to, knows the engineering, has a proper team for evaluating that stuff. That is, that's probably going to be a better strategy than investing in the basket of the GDX or the GDXJ. And can you because maybe we can put a chart up of just comparing the price of gold over the past 10 years to the GDX or the GDXJ. To what do you explain the underperformance in the case of GDX and the drastic underperformance of GDXJ?
Yeah, so there's just not a lot of. So one, you've had over the last 12 years, you've had a big derating of both the seniors and the juniors in terms of where the juniors used to trade at closer to net asset value and the seniors at 2 times net asset value. The juniors are now trading at meaningful discounts, in many cases 40, 50% discount to net asset value, and the seniors are trading at just a slight premium to net asset value. So you've had a big derating. And then the combination of factors that you face when you're investing in gold mines have been unattractive to a lot of investors. So gold hasn't moved sufficiently with inflation. You have the concern that gold's going to go sideways into the future as capital costs for mines go up a lot and operating costs start to escalate. So you have operating costs going up in the high single digits, capital costs going up north of that, in some cases close to 20%. And so if gold prices don't start to rise, you have that squeezing of those margins. And if this is a cyclical peak in the industry, you're only generating high single-digit returns on equity. It's just not sufficient for generalist investors to want to get interested.
How many, junior gold miners would you say are profitable at the current price? What is the current price of gold? I don't know. I'm ashamed to say.
So $1,850 is the price of gold.
$1,850. Okay. How many, your typical junior gold miner, is that profitable at $1,850? And what about your senior gold miner? Is your typical senior miner profitable at $1,850? And then also, what about companies that aren't producing, sort of greenfield projects?
So yeah, the producers are profitable today generally. So you have all-in sustaining costs for the sector today is going to be somewhere around $1,100. So you have a margin versus $1,850 today that producers are generating, and that's true for the juniors as well as the seniors. The issue is that if that gold price goes sideways and those sustaining costs, all-in sustaining costs start to escalate, those margins get squeezed, and it's a very capital-intensive business. And so the IRRs on the projects, even if they're still slightly free cash flow positive, are pretty marginal, and it's not clear if they were worth all the effort and risk of investing. In terms of the non-producers, there's maybe two big categories of those. One's the explorcos, which are going around sticking holes in the ground looking for gold. We're not invested in those companies. But if you talk,
why is that, Sean?
It's a very unpredictable, bad business. It's hard to, gold's scarce. Sticking holes in the ground looking for it is a high risk activity. Somebody else can do that. It tends to be, that's more of a kind of a lottery strategy.
There's kind of a trust. There's a trust level. If I come to you and I say, hey, I found gold, do you trust me?
Well, maybe you, but
okay.
It's just the reality. The problem is, even if you find gold, is it economic, right? Is there enough of it? What are the grades? What's the nature? What's the geology? What's the metallurgy? What's the geometry of the ore body? Is it mineable? Is it actually worth something? And so, but even if you're investing in economic reserves in the ground that just where their mine's not built, those companies tend to be very, very poorly valued, inefficiently valued, and lowly valued today. The main thing investors are looking for there is an asset that's large enough to be taken out at a premium by a major, because the timeline and economics of actually building that mine and developing that asset in most cases aren't attractive to people that have less than a 4 or 5 year time horizon from an investment perspective. And then the population of assets is actually large enough to attract the attention of a large company where you have a willing buyer, and then if you have a willing seller on the part of the junior mining management and board, that tends to be relatively rare. So we have some of those companies that have economic assets, economic reserves, but are very undervalued. But the vast majority of our portfolio is in producing companies. Okay.
So again, not talking about your fund at all, but let's say there's an active gold investor and she invests in companies that are in the GDXJ, and she manages to have solid returns. What let's say she invests in 10%. The 90% that she didn't invest in, the problem ones, what is the problem with them that is sort of dragging the GDXJ down? Is it there's maybe some governance problems? Is it the ore isn't right? Is it the costs are eating it up? What are sort of the problems that has dragged the GDXJ down? Does that make sense?
Yeah. So in the GDXJ, it's 100 companies. Average market cap's about $3 billion. Most of those companies are producing. So the big issue you have right now from a headline perspective is you have capital cost overruns, uncertainty in terms of future capital cost overruns. You have operating cost increases. So some of the procurement budgets that were stable for part of 2021 now have really started to escalate into 2022. I would say those are the number one issues you're facing in that sector. Then you have you have governance problems where you have boards that don't own enough stock. You have boards that have the motivation to make their companies larger rather than generate value on a per share basis. So navigating a lot of those governance issues is a big part of what I think what we do, what investors should do in the space. And then on top of that, you have different geographies where you have threats of taxation. So Chile is a good example right now where companies are going to have, if the constitutional rewrite goes through, they may have their water rights taken away, and then you have potential tax increases on top of that. You go through the list of everything that could go wrong, and it's really pretty substantial. So unless you start to get higher gold prices, I think that population of companies doesn't really make a lot of sense. And I think given the sideways performance of gold in this kind of environment, you now have a fair amount of skepticism about, when and if gold's actually going to perform to justify this kind of even today's valuations and the kind of investment activity you're seeing in the space.
Right, and I should say a lot of the senior gold miners located in Australia, I guess some in Europe, a lot in the United States, a lot in Canada. But the bulk of the junior miners, they typically tend to be in emerging markets, frontier markets. So a lot are in South America, some in Africa. You said South America. What do you think about this sort of jurisdictional risk, and how are you trying to avoid it and seek jurisdictions that are favorable to mining?
So Latin America has been kind of a disaster area for certainly the last 5 years. So not just you've had the elections in Chile and in Peru that have been very negative for the mining business and made it very challenging to invest in new mines there. Argentina has been a problem for a long time. Mexico under AMLO has been incredibly difficult. We have companies that have built mines there but haven't been able to connect them to the grid to power them, to turn them on, and just kind of bureaucratic inefficiencies. Then you overlay on all of that, Latin America was particularly hit by the coronavirus, and you had policies in a number of countries where you had every worker that tested positive took a week plus off. And so you had inefficiencies, costs associated with coronavirus overlaid on top of tough politics. And then you overlay on top of that the NGO activity that you have in Latin America, a lot of which is foreign financed. And so Latin America is kind of the one jurisdiction where we see kind of writ large, where you could see built assets that don't have really any environmental or structural problem actually get shut down. So we have a mine in southern Guatemala that was built in production 5 years ago that has been on care and maintenance for 5 years because they have a local social problem they can't deal with. So that's been a really difficult continent to be invested in the last 4 or 5 years. And then the counterpart to that would be something like West Africa, where you have really for the better part of a decade, you just have mines coming on time, on budget. And there's a lot of different reasons for that, but there's been a lot of value created in that geography as opposed to Latin America over that period of time.
Sean, how do you identify where the risk is? Because I've seen mining CEOs on TV, I've seen interviews with them, and I'm not picking on anyone in particular, but they never say, "Oh yeah, we're actually have a huge jurisdictional risk." Or they're like, "No, we've got a world-class project. We're free cash flow of this. We're right connected to the grid, water. We've got all these advantages. Blah 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 blah." If I could never do your job, Sean, because I'm a believer. I'd be like, yeah. So how do you separate the wheat from the chaff and see which CEOs are telling the truth and the paperwork backs it up, and which are maybe not so much?
Well, I think so. The kind of the end of your question there gives you the answer. Is a lot is the people, and you want to find the people that are invested alongside of you, right? They own the shares as well, and that they have a track record of creating value and behaving well, right? So somebody has a 20-year track record of not creating value and working against the interest of shareholders. I would hope he changes his behavior, but I'm not going to invest on that basis. So you really want to find the right boards and the right C-suites to partner with. I think that's kind of probably the number one factor. And then having additional sources of information within country are really important. I remember there's a company that Centera that had I went to their original listing where they have an asset in the Kyrgyz Republic, and there were like 50 people in the room. And I was like, gosh, I know a lot I just don't know anything about the Kyrgyz Republic. Tell me about what this is like, as a investment geography. And sure enough, they have a lady in the back pop up. She's dressed in the local costume, and she's like, look, we're a thriving democracy. It's going to be fantastic investing there. And I don't know, 15 years later, they expropriate the asset. It turns out it wasn't a great place to invest. So I think you just have to have some experience in separate sources of information in these countries, so you actually know what's going on. Because as you say, the companies themselves aren't often in the business of being as honest as they should be about the local issues that they encounter.
And does an asset have a lower likelihood of getting expropriated if it's majority owned by people in that country? For example, like if it's listed on an African stock exchange and it's owned by a lot of people there, they're not gonna, these sort of elite miners, and they're not gonna let their friends in government expropriate that, right? But if it's owned majority by Canadians, they'll be like, yeah, we're expropriating this.
So the assets tend not to get expropriated. That's not really. So that's kind of the quick way to talk about some kind of impairment of the asset. They tend to get frozen. It tends not to be actually national policy. The issues tend to be the local community issues tend to be the ones that are the most unworkable or insoluble. The national governments tend to be interested in doing a deal. And there's pretty good parameters in terms of what the take are, whether they're taking 40% or 50%. There's a range, but it's not an infinitely large range. And then every government understands that they can't actually operate a mine. It's not like oil and gas asset. There's no real possibility, I think, for rational people to believe that a government can actually operate a mine. And so there you're just really negotiating where you are in the 40, 50% government take when you're talking about a countrywide issue. When you go to the community issues, you'll have maybe 2 or 3 of the local communities are getting economic returns from the asset, but one's not. Maybe you have indigenous issues or a tribal issue where people just feel like they're not really participating in the returns of that asset, and then they're not interested in changing the economics slightly. They're interested in stopping that asset from going into production. And so that's where you really you can lose an asset, in my experience.
And what would a situation be like where, indigenous populations raise an issue and the miners can meet that issue and everyone can benefit, versus something where it just they end up shutting down the mine?
So in terms of there's 2 sources of money for a lot of these communities. One source of money is the mine. The other source of money is foreign anti-mining money. And so it depends upon. Yeah.
What is this NGO? Who's funding it? Is it the United States? Is it Europe? Where's the money coming from?
Yeah, so it's U.S. and European money. And the U.S. and European money is generally not there to make sure that the mining is done to best practices. The U.S. and European money is usually there to prevent the mining from happening. And so, so those negotiations tend not to be fruitful. And a lot of the court systems can be very politicized. And so you can get stuck in a local court system where really there's the timeline to get out of that is, way beyond our investment timeline. So we're invested in a company in the western part of Mexico where their mine permit has been declared unconstitutional. We had an asset in Peru where was protested by a local indigenous community, and their license was revoked prior to a presidential election. We have the asset in Guatemala. Maybe that's the kind of most glaring one, where local tribe, the Xinca tribe, had claimed that this was a violation of a treaty level agreement that Guatemala had regarding indigenous peoples, and that's been in a 5-year legal process, despite the president's support for that mine, and despite that mine having really no technical issues. It's been 5 years. So, and I guess the point I would highlight to you is every single one of those examples I'm giving to you is in Latin America. So the opposite has generally been true in our experience in West Africa, where if you did a deal, you had a commercial deal, you were able to execute that on that, and you were able to basically navigate some of the local issues and create the community benefits in terms of jobs and employment and economic development, and the tax benefits for the government, such that you didn't really have a lot of unexpected issues after you decided to proceed with the investment in the project.
How long do these mines last? And how long does it take before their production curve tends to go down? And then how do the markets value that as it's producing less and less gold every year? And then final question, how do you value that?
So the short answer is no two mines are alike, right, or the same, right? So there's a lot of variation from asset to asset, and that's one of the things that makes mine investing so complicated. So sometimes mines will have a life. We have one in Bulgaria that had a life of 7 years. Most of the mines we're invested in are going to have lives beyond 10 years. Mining companies generally want life of mine beyond 10 years from today. And if they see that 10-year production profile start to tail off, you're going to see boards and C-suites start to look at either expanding those assets, spending more money on exploration, or making acquisitions to fill in that production profile. So even if it would make sense financially to shrink production, you have very few companies in the mining space that are ever going to do that.
What does the global supply of gold look like? I know when it comes to oil, coal, natural gas, it's pretty likely that humanity is going to stop using them before we fully run out of them. Maybe I'm wrong about that, but that's the way it seems. Whereas like gold, never going to run out of gold, but it's just going to be in such small quantities that it's going to cost so much to get it out of the ground. Like how slim are the pickings now compared to 50 years ago? And, in maybe 20 years, how much more slim are the pickings going to be than now?
So gold's different than, gold's money and has been used as a money historically because it's not really consumed. So unlike everything else that we produce, whether it's oil or even something like a monetary metal like silver, which is consumed in a lot of industrial processes, gold's not consumed. So if there's 7 or 8 million ounces of a billion ounces of gold above ground, that's pretty close to a representation of what's ever been cumulatively produced in human history. Maybe a couple people get buried with gold, but broadly speaking, the gold's not being consumed either in industrial processes, or individuals aren't destroying the gold that they have. So you're not going to run out of gold. And then mine supply it varies a little, but it tends to be 1% to 2% of that total stock of gold on an annual basis. And that's been broadly consistent for most of the last 100 years. Okay.
Well, Sean, we're running a little long in the tooth. I've really enjoyed our conversation. I guess, is there anything you want to leave our audience with before we go?
I don't know. The world's changed, right? So the disinflationary tech stocks ever higher environment is, I think, in the rearview mirror, and I think investors probably should get smarter about oil and gas and gold mining because I think there's still, I think we got a long runway ahead of us still.
Wonderful. Got you. All right. Well, Sean Fieler, thanks so much.